Greetings, Jonathan Camarda, your humble CIO. Hopefully everyone is doing well, and hearts reach out to anyone who was affected by the storm. Certainly, at least here in the Southeast, folks around the country that we serve have your own natural calamities down here, hurricanes, so definitely heart reaches out to you. If there's anything we can do, certainly to help you guys out, or if you need funds, etc., let us know. As far as markets go, obviously the Fed went 50 basis points this past month, and you've seen a surge in the markets. The reason they may have done it, no one really knows as prognosticators, whether they're trying to get ahead of an increasingly weak labor market or trying to tiptoe around the November timeframes. We'll leave that for other programming. What it has shown, though, is the market has reverted back to its pre-July programming, so to speak. So really going into July, the market large cap growth, right? You saw technologies leading the way. And then from July really until that early part of September, you saw mid cap, small cap value companies, right? Slower movers, more defensive companies starting to outperform versus growth. We've seen now a reversion since the Fed made that move. Now, once the Fed drops the rates and as such, of course, from a currency standpoint, the dollar, which was already losing some of its footing, has become increasingly weaker versus its counterparts. Makes sense, right? When a country drops its rates, again, there's less flows into the market, the currency drops, okay? So from that standpoint, that is actually attractive for equity markets of that country a lot of times, especially the large cap companies that sell their goods overseas, right? Because it's cheaper for other folks internationally to buy, right? Pretty simple economic concept there. So we have seen a handing back of the baton from, number one, value to growth, and then also small and mid cap value to large cap. Will it sustain? Likely right now, given the macroeconomic situation. Now, from a sector standpoint, year to date, we've seen utilities, financials, again, which plays that rate game, and also consumer communication sector also outperforming. Now, utilities is a little bit of a dichotomy there, as many folks you'll see saying, well, utilities doing well usually portends of a slowdown. And that is true. It is a defensive sector, and we may be heading into recession. Those that say it's going to be soft, hard, it's not going to happen, probably too soon to say that. 2007, when the Fed dropped rates, the market continued to chug for a while, and then it dropped. Not saying we have another housing crisis, but you never know until the culprit shows themselves. So too soon is all I'm saying to project on that. However, utilities has kind of a dual-edged sword, right? Utilities usually defensive. However, you may have heard of this little thing called, I don't know, AI. Maybe the most ubiquitous two letters since E.T. And so with all of the infrastructure that needs to be built, guess who's benefiting? You got it, utilities. So utilities are kind of a wolf in sheep's clothing version of technology, piggybacking on it. All right, so what you have now is utilities outperforming, but there definitely is a bifurcation there, and the assumptions based upon the economic cycle cannot be played with the old textbooks we were reading back in the 90s on that one, so stay tuned. Now, as far as fixed income and bonds, you may have seen an increased component as it has become more attractive in the playbook versus 2022 with the yield curve uninverting. So rates again going down helps out again fixed income prices going up across different duration periods. So in our conservative strategy, like an active capital preservation, certainly take advantage of that mixed in with mortgage-backed securities, Ginnie Maes, etc. And that is the playbook there. Even on aggressive strategies, you may have seen again some income inputs, not a great deal, but a little bit of as a brake pedal, and then also as an appreciator given where we are in the macro landscape. So again, two things that I'll mention now. With the market now regaining its footing, remember, September is usually a red month, historically the weakest month of the year. With the Fed pivot, however, it ended up green. October, again, a little bit more 50-50 than September, can be up or down, but again, it is still a seasonally weak period time of year. Two things that we're looking at here, three things. We'll get to the first. Consumer sentiment is actually weakening, however. Why does this matter? Well, if you go back to the tech bubble, the financial crisis, COVID, 2022, consumer sentiment reversed and went down, the market continued going up, and then eventually, like an anchor tied around its neck, followed suit. So we want to be cognizant of that, and not too surprising with, again, employment numbers getting weaker and weaker, it makes sense as well. Now, on the housing front, right? The dropping in rates has helped, although most real estate analysts think that rates have to come down a little bit more to justify folks ponying up the money to offset the cost of rent, with mortgages and the repairs and everything else still being more of an expensive play at this point. So again, we'll have to see how that seesaw adjusts accordingly as well. Now, as we get back to earnings, however, a positive shift in earnings, as earnings, generally the most attractive thing that can happen for future earnings growth is when sales and profit margins, net and gross profit margins, are actually the driver versus just what they call multiple growth. That just means the company keeps going up, but at the same time, not necessarily due to the infrastructure of profit margins. We've seen a turn from September to from July that profit margins and sales are driving some of this growth, which portends for potential, again, positive earnings moving forward. That's at least domestically. Globally, they're still looking at weaker economic forecasts, so we have to watch that. Not surprising. If you look at globally, you see these, again, international banks actually easing, bringing down rates as well, as many of them certainly beat the Fed to the proverbial poker table. And the most recent mantra, and we'll finish with this one, would be China. Of course, we know China, it's binary. The faucet could be cold or it could be hot. And they just turned the hot faucet on and encouraging deployment into risk assets, as easy as it is. And now you see institutional money, hedge funds, etc., the smart money, the money knows what, when, where, how, why, and how, when we're still trying to figure out what to have for breakfast in the morning, diving in. In your more aggressive strategies, you'll notice when surf's up, those can ride for a while. So you'll see an infusion there for aggressive strategies as well. As far as where we go from here, it is pretty interesting, because October can go either way, leading into an election rather, easy for me to say. Generally, the market has a correction beforehand and then glide paths after. That textbook's been thrown out of the window, so to speak. With the Fed pivot, we shall see if we continue to glide through the rest of the year or just until November. We'll have to stay tuned. We will stay eternally vigilant regarding the weather out there. Another storm coming up. Not a meteorologist, although I can't say the word, but I did stay at a Holiday Inn Express last night, I think. So watch out for storms there. Be vigilant on that. We'll be vigilant with your accounts. Any changes you've had, talk to your personal wealth advisors as I reach out proactively to my clients as well. Whether your team is winning or losing, stay frosty. Most important things in life are family, your health, and somewhere in there, maybe a distant number 3, what we do for you. And it is a privilege to do so. Until next time, Jonathan Camarda, signing out.